One of the biggest myths perpetuated by the financial industry is the belief that professional money managers can consistently outperform the market. Let's see if it's true. In his well-researched book, Money, Master the Game, Tony Robbins dismantles the idea by presenting compelling evidence that most actively managed mutual funds fail to deliver returns better than those of a simple index fund. In fact, over a 10-year span, around 96% of actively managed funds underperform the S&P 500 index after accounting for fees and taxes. So why does the myth persist? Robbins argues that the financial industry thrives on complexity and perceived expertise. Fund managers and investment firms spend enormous amounts of money on marketing and advertising, selling the illusion that their teams, algorithms, and investment philosophies can deliver market-beating returns. Yet historical performance data shows otherwise. Even legendary investor Warren Buffett famously made a bet against active management, choosing a low-cost index fund over a group of hedge funds. After 10 years, Buffett's index fund significantly outperformed, proving that simple often beats sophisticated when it comes to investing. Robbins highlights how active funds charge higher fees, often in the range of 1 to 3%, which might seem small at first glance. However, these fees compound over time and dramatically decrease the investor's net returns. Even if an actively managed fund beats the market by a small margin before fees, the net return after fees typically falls short of the index fund benchmark. What's even more alarming is the lack of accountability. Many fund managers don't invest their own money in the funds they manage, indicating a lack of confidence in their own strategies. This disconnect raises questions about their motivations. Are they truly working to grow your wealth, or just collecting fees regardless of performance? Robbins urges readers to shift their mindset. Rather than trying to beat the market, investors should aim to match the market with as little cost and risk as possible. Index funds, which passively track a market benchmark like the S&P 500, offer broad diversification, low fees, and long-term consistency, traits that lead to more reliable wealth building over time. In essence, the myth that financial managers can consistently outperform the market is just that, a myth. Robbins empowers individuals to take control by focusing on cost-effective strategies like passive investing. The goal isn't to be smarter than the market. It's to participate in it intelligently and efficiently, ensuring you keep more of your gains instead of handing them over to Wall Street middlemen. Thanks for your time, and until next time, be well.